Did you know that there's a market worth over $1 trillion that impacts your mortgage, your job, your investments, and even the price of crypto? A lot of people don't know how this market works, or even what this market is. And no, it's not the stock market, it's not Bitcoin, it's the bond market, and it's the most important piece of the global financial system.
Imagine waking up tomorrow and finding out your mortgage payment just became more expensive. Your retirement account has dropped. Another major company announces thousands of layoffs, and the government says it needs to borrow even more money. Most people would blame inflation. Others would point to the Federal Reserve. Some would blame politicians, billionaires, or whatever headline happens to be dominating the news. But what if I told you that all of these stories are connected by one market that most people never even think about? A market so enormous that it's worth more than $130 trillion. A market that quietly influences your mortgage, your investments, your job security, and even how much the government can afford to spend. It's called the bond market, and if you don't understand bonds, you're missing one of the biggest pieces of the global financial puzzle. Today, we're going to change that. Let me ask you a simple question. When was the last time you watched the evening news and heard someone say, "Bond yields are rising"? Maybe you've heard the phrase before. Maybe you ignored it because it sounded like financial jargon meant for economists on Wall Street. That's exactly what most people do. The truth is, the bond market rarely grabs headlines the way stocks, cryptocurrencies, or artificial intelligence do. Yet behind the scenes, it's quietly setting the price of money for almost everyone. Think about it for a moment. Why did mortgage rates nearly triple in just a few years? Why did companies suddenly start announcing layoffs? Why did investors begin moving billions of dollars away from stocks? Why did borrowing become so expensive for families and businesses? The answer isn't hidden inside your local bank. It starts in the bond market. Let's forget Wall Street for a minute. Imagine your friend wants to start a small business. He asks if you can lend him $100. He promises that every year he'll pay you $5 as interest. Then, after 10 years, he'll return your original $100. That's it. You just became a lender. And your friend just issued a very simple bond. A bond is nothing more than an official promise to repay borrowed money. Instead of borrowing from a bank, the borrower borrows directly from investors. Now imagine replacing your friend with the government. Governments spend enormous amounts of money every year. They build highways, fund schools, support healthcare, pay military salaries, maintain infrastructure. But here's the problem. Governments don't always collect enough tax revenue to pay every bill. For example, imagine a government collects around $5 trillion in taxes but spends nearly $7 trillion. That leaves a huge funding gap. Where does the missing money come from? The answer is simple. It borrows. First is the principal. That's simply the amount of money being borrowed. Second is the coupon. Despite the name, it has nothing to do with shopping discounts. The coupon is the fixed interest payment the borrower promises to make each year. Finally comes the maturity date. That's the day the borrower must return the original money to the lender. Now that you understand what a bond is, let's talk about the one concept that confuses almost everyone the first time they hear it. Bond yields. You've probably heard news anchors say things like, "Treasury yields climbed today," or "Bond yields are falling." For most people, those headlines mean absolutely nothing. Let's go back to our simple example. Imagine you bought a government bond for $100. That bond pays you $3 every year. Nothing changes about that agreement. You'll still receive $3 each year until the bond matures. Now imagine something unexpected happens. Inflation begins rising. The economy changes. Interest rates move higher. As a result, the government starts issuing brand new bonds that pay $4 every year instead of $3. Now ask yourself one question. If you were an investor, which bond would you rather buy? The old bond paying $3, or the new bond paying $4? Both costing $100? The answer is obvious. Everyone wants the new bond. Suddenly, your older bond isn't nearly as attractive. If you want to sell it, you'll have to lower the price until another investor believes it's worth buying. Maybe instead of selling it for $100, you sell it for $90, maybe $80, perhaps even $70. Notice something important. The bond itself hasn't changed. It still pays $3 every year. Only the price has changed. Now imagine someone buys your bond for $70. They're still receiving $3 every year. And that's exactly what happened over the last few years. As bond yields climbed sharply, banks increased mortgage rates. Businesses faced more expensive loans. Governments paid more to borrow. Consumers found it harder to finance homes and cars. The cost of money rose for almost everyone. But perhaps nowhere was the impact more visible than in the housing market. How did that happen? The answer has everything to do with one specific number: the 10-year government bond yield. And once you understand why banks pay so much attention to it, you'll finally understand why mortgage rates changed so dramatically in such a short period of time. At this point, you might be wondering, if bonds are traded by governments and large investors, what does any of this have to do with buying a house? The answer is almost everything. Many people assume banks simply choose mortgage rates based on whatever profits they want to make. But that's not how the system works. Before a bank decides what interest rate to charge you for a mortgage, it first looks at one important benchmark: the 10-year government bond yield. Why? Because lending money to the government is considered one of the safest investments available. Governments can raise taxes, issue new debt, and have enormous financial resources behind them. Since banks are taking on additional risk, they don't simply match the government bond yield. Instead, they add a safety margin. This extra margin helps compensate for the possibility that some borrowers may fail to repay their loan. Think of the government bond yield as the foundation of a house. Everything else is built on top of it. If the foundation rises, everything above it rises too. That's why mortgage rates often move in the same direction as government bond yields. Now let's see what this looked like in the real world. Back in early 2021, borrowing money was unbelievably cheap. The 10-year government bond yield hovered around 1%. Mortgage rates fell to roughly 2.65%, the lowest levels many homebuyers had ever seen. Imagine you're shopping for a home. At such low interest rates, your monthly payment is surprisingly affordable. Suddenly, families who once qualified for a modest home could now afford a much larger one. Others who had been waiting on the sidelines rushed into the market before rates climbed. Demand exploded. And when millions of buyers compete for a limited number of homes, prices don't stay still. They rise. Fast. In many places, home values surged at a pace rarely seen before. People weren't necessarily buying more houses because their incomes had doubled. They were buying because borrowing had become incredibly inexpensive. Cheap money fueled expensive homes. But markets rarely stay the same forever. As inflation accelerated and interest rates began climbing, bond yields followed. Within a relatively short period, the 10-year government bond yield approached 5%. Mortgage rates climbed above 8%. That single change transformed the housing market almost overnight. Let's imagine two families purchasing the exact same house. The first family buys during the era of low interest rates. The second buys after mortgage rates have climbed above 8%. Even if the home's price hasn't changed, the second family's monthly payment could be hundreds or even thousands of dollars higher. The house is the same. Their income may even be similar. The difference is simply the cost of borrowing. And that's exactly what rising bond yields do. They quietly reduce purchasing power. Fewer families can qualify for large mortgages. Demand begins slowing. Normally, economists would expect home prices to fall when fewer buyers are competing. But something unusual happened. Millions of homeowners had already locked in mortgage rates near 2 or 3%. Selling their homes would mean giving up those incredibly cheap loans and replacing them with mortgages costing 2 or 3 times as much. For many people, that made moving financially impossible. Instead of selling, they stayed put. As a result, fewer homes entered the market, demand weakened, but supply shrank as well. That unusual combination kept housing prices surprisingly high, even as mortgage affordability reached some of its worst levels in years. It's a perfect example of how one movement in the bond market can create ripple effects throughout the economy. Without ever mentioning bonds, people found themselves asking, why are houses still so expensive? The answer wasn't just about real estate. It began with borrowing costs, and borrowing costs began with bond yields. But housing is only one piece of the puzzle. The bond market doesn't just influence where people live. It also shapes where trillions of investment dollars flow every year. And that's one of the biggest reasons stock markets experience massive booms and painful crashes. Let's see how that works next. So, why do bond yields rise in the first place? At the heart of it all is a simple idea. Investors want to protect the value of their money. Imagine lending someone $100 today. If you expect prices to stay stable over the next 10 years, earning $3 a year in interest might seem perfectly reasonable. But what if you believe inflation will remain high? Suddenly, that same $3 return doesn't look nearly as attractive. Every year, the money you receive buys a little less than it did before. To compensate for that loss of purchasing power, investors begin demanding higher returns before they're willing to lend their money. That's one of the biggest reasons bond yields rise. Central banks also play a major role. When inflation becomes too high, central banks often increase short-term interest rates to slow the economy. Higher rates encourage saving instead of spending and make borrowing more expensive. As markets adjust to those higher rates, government bond yields often move upward as well. And that's where the chain reaction begins. Higher bond yields make mortgages more expensive. They increase the cost of financing for businesses. They reduce the appeal of riskier investments like stocks. Companies spend more on interest payments and less on expansion. Hiring slows. Layoffs become more common. Consumers cut back on spending. Economic growth begins to lose momentum. What started as a movement in the bond market gradually spreads through almost every part of the economy. That's why professional investors watch bond yields so closely. They understand that the bond market often signals changes before those changes appear in company earnings, employment reports, or headline news. In many ways, the bond market acts like an early warning system. It doesn't predict the future with perfect accuracy, but it often reveals where money is flowing and where financial conditions are becoming tighter or more supportive. For everyday people, this doesn't mean you need to become a professional bond trader. It simply means understanding that the economy is connected. The interest rate on your mortgage isn't determined in isolation. The performance of your retirement portfolio isn't driven only by stock prices. Even the financial decisions made by the company you work for are influenced by the cost of borrowing. The bond market sits quietly beneath all of these decisions, connecting governments, banks, businesses, investors, and households in ways that most people never notice. And perhaps that's the biggest lesson of all. The most powerful forces in the economy aren't always the ones making headlines. Sometimes they're the ones working silently in the background. So the next time you hear someone mention rising Treasury yields or falling bond prices, you'll know they're talking about much more than a niche financial market. They're talking about the cost of money itself. And once the cost of money changes, almost everything else begins to change with it. Because in the end, understanding the stock market may help you become a better investor. Understanding the housing market may help you make better buying decisions. But understanding the bond market helps you understand how the entire financial system fits together. If you understand bonds, you don't just understand one investment. You understand the invisible engine that powers the modern economy. If you enjoyed this breakdown and want more simple explanations of the financial forces shaping your everyday life, consider subscribing. There's always another hidden piece of the economy worth uncovering, and we'll break it down together in the next video.